Welcome to The Deep Dive, your ultimate shortcut to being well-informed. Today, we're taking a deep dive into the second quarter 2025 earnings call for Stryker. They're a true titan in the medical technology space. Our mission, as always, is to cut through all that corporate speak, highlight the most important insights, and really deliver the essential takeaways you need so you can understand Stryker's recent performance and their outlook moving forward.
Yeah, it was a fascinating call, actually. And right off the bat, Stryker delivered a really strong quarter. We're talking robust double-digit growth, both sales and earnings, which is, pretty impressive in the current environment.
Absolutely. When you look at the headline numbers, organic sales growth hit, 10.2%?
10.2%.
And what's notable there is that's actually an acceleration. It was 9% in the same quarter last year. So things are picking up speed.
Exactly.
And on the profitability side, adjusted EPS, earnings per share, climbed 11.4%, up to $3.13. That's a solid beat.
A very solid beat. And look, this wasn't just a one-off performance. This strength was pretty clearly driven by, persistent strong demand across what is a remarkably diverse product portfolio, plus, continuous innovation, and what management kept calling disciplined operational execution.
Right, that phrase came up a lot.
It did.
Yeah.
And what's really impressive, I think, is they achieved all this while actively navigating some pretty significant headwinds. Stuff like the impact of tariffs, the temporary Anari dilution, that's basically the short-term earnings hit from integrating that big acquisition.
Before it really starts paying off, yeah.
Exactly, before it fully contributes. And also dealing with the strategic divestiture of a spinal implant business.
Yeah.
So lots going on.
And it wasn't just looking back, was it? Management sounded genuinely confident looking forward. They actually raised their full year 2025 outlook for both organic net sales and adjusted EPS. That feels like a powerful signal, especially when, a lot of companies are still being pretty cautious out there.
It certainly is, yeah. When a company raises guidance like that, it usually means they have pretty strong visibility into their business for the rest of the year. Now, if we dig a bit deeper, maybe to the underlying financial performance.
Yeah, let's do that.
Okay, so on the sales front, there were a couple of, interesting nuances. They got a favorable pricing impact of about 0.5%, 0.5%, and also a foreign currency tailwind of 0.8%. Both of those significantly contributed to that top-line growth.
And those percentages might sound small, but for a company Stryker size?
Oh, yeah, they translate into tens of millions of dollars. Absolutely.
And that robust sales growth clearly translated directly to margin expansion, which is, always a key indicator of efficiency. Adjusted gross margin improved by 120 basis points year over year, hit 65.4%.
Right, 1.2 percentage points. That's significant.
And management attributed this mainly to cost improvements. The adjusted operating margin also saw a healthy bump, right? Up 110 basis points to 25.7% of sales.
Yep, and that mirrors the kind of expansion, around 100 basis points, that we also saw back in Q1.
So it's not a fluke. It feels like a trend.
Exactly. And what's fascinating here is how they're driving that margin expansion. It's not just about, hiking prices. Their commentary suggests a really concerted effort in manufacturing efficiency, lean initiatives across their facilities, smarter procurement.
Getting leaner.
Yeah, basically getting more efficient in how they make and move stuff.
Right.
Which directly cuts costs. And, this is tangible evidence that their multi-year investment in streamlining these operations, it's paying clear dividends now.
Yeah.
Kind of sets them apart.
Right. Especially compared to competitors maybe still grappling with those cost pressures. And that consistent margin improvement obviously flowed through to the bottom line. Adjusted EPS saw that 11.4% increase we mentioned, which also got a little help, about 4 cents from favorable foreign currency translation.
Oh, yeah.
Cash flow is also looking really strong. Year-to-date, $1.4 billion from operations.
Which reflects those higher net earnings, but also improved working capital management. Basically, they're handling their cash and inventory better.
Okay, got it.
One notable financial point, maybe a bit in the weeds, was the adjusted other income expense line. It increased by $52 million to $16 million. Now, this was mainly due to higher interest expense. It stems from recent debt they took on in late 24 and early 25, likely for acquisitions.
Okay, so the cost of doing those deals.
Pretty much. It's an important detail to track, but clearly the overall strength of the business more than offset that increased expense this quarter.
Okay, so we've laid the groundwork with those, frankly, impressive headline numbers. Let's maybe peel back the layers now. Let's discover the strategic plays Stryker is making across its different business segments that are really fueling this growth.
So I'm good.
The MedSurg and Neuro Technology segment was an absolute star, wasn't it? 11% organic sales growth.
Yeah, really strong. And within that, endoscopy was a real standout. Phenomenal 18.6% U.S. organic growth.
Wow. What's driving that?
Well, robust demand for OR infrastructure. The continued success of their 1788 video platform, that's their high-def surgical camera system.
Right.
And also new shoulder products and sports medicine seem to be doing well.
Okay.
Instruments also showed strong U.S. growth, 10.1%. That was driven by surgical tech like their Neptune waste management system.
That helps with fluid disposal, minimizes infection risk.
Exactly. And also smoke evacuation systems.
Yeah.
That last point is actually quite relevant because 19 states now have smoke-free OR legislation.
Ah, so regulation is actually creating demand there.
Precisely. Driving demand for those solutions.
And the innovation keeps rolling with neurocranial and IBS, interventional spine.
Yep, neurocranial grew 14.8% organically in the U.S. And IBS, well, management described it as one of Stryker's fastest growing businesses. This is thanks to successful products like OptiBlate and also the very recent Veritas acquisition, both targeting key spine procedures.
Okay. And vascular. The growth there was a bit more modest.
It was, yeah. 1.4% U.S. organic sales growth this quarter. But management expects a significant improvement in the second half. This is largely because of recent launches that are just starting to gain traction. Things like the Surpass Elite Flow Diverter, the Access Lift Catheter, and the newly launched Broadway Large Bore Aspiration Catheter.
Yeah.
That one's pretty strategic because it's cleared for aspiration use in stroke cases.
Which is a critical high-growth area.
Absolutely.
Now, in their medical segment, they did mention some supply disruptions, particularly in emergency care.
They did, yeah. Some isolated issues. But despite that, their acute care business still saw double-digit growth.
And there's good news on the defibrillator front, the LifePak 35.
Right. That one isn't affected by the supply issues. And importantly, it just received European approval. They expect to launch it there in late Q3.
That sounds like a product with significant potential globally.
Definitely. So while MedSurg and Neuro Tech really shone, maybe the real standout story and perhaps the future of the company lies within orthopedics. That segment posted a solid 9% organic sales growth overall, driven by some very compelling innovations.
Right. And within orthopedics, trauma and extremities really stood out, didn't it? 13.6% organic growth.
Yeah, robust growth there, largely propelled by the Pangea plating portfolio. That just celebrated its one-year launch anniversary. It continues to drive strong adoption, and they're adding new MIS, minimally invasive surgery plates to it as well.
So Pangea is that flexible system for complex fractures. Seems like surgeons are really liking it.
The rapid adoption definitely speaks volumes, yeah.
Yeah.
Okay, but here's where it gets really interesting. MAKO, the MAKO Robotics platform, it reached a huge milestone. 2 million robotic procedures performed.
2 million. Just pause on that number. That's incredible penetration.
It really is. And it's not just a vanity metric, right? Stryker reported its best ever second quarter for MAKO installations globally. And crucially, they're seeing remarkably high utilization rates once these systems are installed. They're not just sitting there.
So hospitals are buying them and using them extensively.
Yeah, exactly. And the new MAKO 4, which features hip revision and now spine applications, has apparently seen a seamless transition. They highlighted surgeon feedback, particularly praising the revision hip application for making what's typically a really complex procedure significantly easier, more precise.
Like having a super accurate GPS for surgery.
That's a good analogy. Yeah. And MAKO spine and shoulder applications, they're on track for full launches. MAKO shoulder is actually migrating to the MAKO 4 platform for its full launch next year, which probably means even more capabilities.
And you can see the MAKO momentum having a kind of halo effect elsewhere in orthopedics.
Definitely. Those high utilization rates, the new installs, they contributed directly to 6.2% U.S. knee growth and 8.4% U.S. hip growth. Plus, that's also supported by the continued success of their Insignia hip stem. It all works together.
Okay, so beyond the specific segments, let's unpack their bigger strategic growth drivers. M&A seems key.
Yeah, absolutely. Management said they maintain a healthy deal pipeline. They're expecting, quote, a deal or 2 or 3, mostly smaller tuck-ins, before year-end.
Tuck-ins make sense, but what really caught my ear was the comment about financial bandwidth.
Ah, yes. They explicitly stated they have the financial bandwidth for another Anari-sized acquisition.
Which was a huge deal. So that raises the question, how are they going to leverage that kind of firepower in this market? It signals a real appetite for more big moves.
It really does. Big M&A is clearly still on the table.
Another key trend they're writing is the shift to ambulatory surgery centers, ASCs.
Right. Those outpatient facilities doing surgeries outside the hospital, that trend is just accelerating. It lowers healthcare costs. It's often better for patients and surgeons.
And Stryker sees this continuing across specialties.
Yeah, they cited increased reimbursement for things like total ankle procedures and ASCs as an example. So more complex stuff is moving there, and Stryker's positioned for it.
Okay, how about internationally?
Well, despite some ongoing supply chain stuff, international organic sales grew a solid 6.5%. Strong contributions from places like South Korea, other emerging markets. Europe's a bit slower on new product approvals because of the stricter regulations, that EU MDR bottleneck.
Right, we hear that from a lot of companies.
Yeah, the common theme. But other places like Japan are proving to be strong growth areas, especially for MAKO, so they're finding specific regional opportunities.
And looking even further ahead, AI seems to be a big focus.
Oh, definitely. They're aggressively pursuing AI integration. They already have FDA-approved products like Blueprint for surgical planning.
That uses AI to optimize the procedure plan.
Exactly. And GA Surgical for quantifying hemoglobin, which helps track blood loss during surgery. And significantly, they've brought on a new Chief Digital Information Officer, specifically focused on generative AI.
Okay, so they're serious about this.
Very serious. They said more details are coming at an upcoming investor day. They're clearly leaning heavily into this whole transformation.
Right. Now, this brings us to some of the, let's say, integration efforts and maybe ongoing challenges they're navigating. Anari medical integration.
Yeah, it's progressing. But Q2 did see some temporary disruption, mostly from destocking distributors, reducing inventory, and also some Salesforce transitions. Management used the phrase bad medicine early on. They implemented non-competes for former Anari staff and put Stryker's own leadership in charge.
Taking control quickly, basically, even if it caused some short-term pain.
That seems to be the idea. They believe it sets them up for long-term success. And despite that disruption, they still expect double-digit pro forma revenue growth for Anari in 2025. They're guiding to about $590 million for the 10 months alone of this year.
Okay. And tariffs. Still a factor.
Still a factor, but maybe slightly less than feared. The estimated net impact for 2025 has been revised down a bit to $175 million from $200 million.
Why the change?
It reflects a reduction in the U.S.-China rates, but that's partially offset by increased tariffs with the EU.
Okay, so a mixed bag.
Pretty much. And they expect that impact to be more pronounced in the second half as inventory bought under the older, higher rates get sold.
Got it. And lastly, China. How are they approaching that market?
Carefully.
Yeah.
Very carefully, post-VBP, that's volume-based procurement, the government initiative driving down device prices.
Right.
So Stryker's focusing on localized products, sustainable growth, not really aggressive expansion that might kill their margins. It's still a key long-term market, but they're being cautious, strategic.
So pulling it all together, what does this really mean for you, the informed listener? I mean, Stryker's ability to deliver double-digit growth, raise guidance, while facing all these macroeconomic uncertainties, supply issues, integration challenges, it really underscores the durability of their business model, right? Yeah. And the strength of that diverse portfolio. They're not just growing, they seem to be growing resiliently.
I think that's right. And if you connect this to the bigger picture, you see these clear drivers for continued growth. The rapid adoption of robotics, MAKO specifically, strong capital demand from hospitals and those ASCs we talked about, and their consistent stream of successful new product launches, MAKO 4, Pangea, LifePak 35, Broadway catheter, the IBS stuff. These are real catalysts.
And that consistent operating margin expansion, even with tariffs and integration costs, it really highlights effective cost management, manufacturing efficiencies. That kind of discipline is absolutely critical right now with inflation still lingering. It signals a very well-managed operation.
Agreed. And don't forget the M&A outlook. That stated financial bandwidth, the active pipeline, it suggests acquisitions will keep being a powerful growth lever, likely complementing their strong organic efforts with those tuck-ins. But maybe, just maybe, another larger deal down the road.
And finally, they seem exceptionally well positioned for those big macro healthcare trends, the shift to ASCs, the increasing role of digital tech, AI in surgery. These trends aren't just about market share. They're about lowering healthcare costs and improving patient outcomes. That feels like a powerful long-term combination.
Absolutely. Which brings us, neatly perhaps, to our not financial advice segment.
Ah, yes, the outrageous but plausible trade idea. Lay it on us.
Okay, here it is. A long-term bullish play on Stryker itself, coupled with a short position on smaller, maybe single-application robotics competitors.
Okay, long Stryker, short, smaller robotic players. Tell us the outrageous part. What's the core thinking there?
Right, so the hypothesis is this. Stryker's MAKO platform is multi-application, hips, knees, soon spine, shoulder, and it's continually evolving. Combine that comprehensive platform with their proven sales muscle and their demonstrated ability to integrate big acquisitions like Anari. The bet is they'll continue to consolidate the orthopedic robotics market.
Squeezing out the smaller guys.
Potentially, yeah. Putting significant pressure on less diversified players. Those who might struggle with the sheer R&D spend needed to compete across multiple applications or struggle to get adoption beyond their initial niche, especially as MAKO keeps expanding internationally.
So the outrageous part is betting the market fully recognizes this winner-take-most dynamic, that a comprehensive platform beats specialized ones long-term.
Exactly. It's a bet on strategic depth and breadth versus just a niche focus in the long run. Plausible, but definitely requires conviction.
Okay, interesting thought to chew on. So, to recap today's deep dive, Stryker delivered a really impressive Q2, strong organic sales, strong EPS growth, driven by relentless innovation, smart execution, and just robust demand across their businesses.
Yep. And their raised full-year guidance reflects that deep confidence in continued momentum, especially from key platforms like MAKO.
They've clearly shown they can navigate some complex challenges, supply chains, integrations, tariffs, while still investing aggressively in high-growth areas like robotics and digital.
Setting a pretty solid foundation, it seems, for sustainable future growth.
Now remember, this discussion, as always, is for informational purposes only. It is absolutely not financial advice. We really encourage you to dig deeper into the details yourself and consider how this information applies to your own investment thesis.
So, what stood out to you from this call? We always value your insights and questions.
We look forward to your feedback and to our next earnings call, Deep Dive.